We talked about this is the operations, right? This is how our business generates revenue. It's like your cash, it's your equipment, it's all the stuff that you use to conduct your business. And we talked about how this side is the finance side. This is how we pay for all that stuff that we need to conduct our business. So now my question is, why would you ever borrow? Okay. What is the benefit of taking on debt? Why do businesses do that? Does anyone have a intuition or an answer? Why would you not just bring in new owners and not worry about having to pay off a loan and worry about bankruptcy? Why do companies borrow? You as the owner, you want to maximize your returns. Okay, so we're gonna go more into this decision that's made in corporate finance of how much to borrow later in the class. But I'll just leave this idea with you in in simple terms of a house. Okay, if you buy a house for 500K, let's say you buy it all cash, so zero borrowing, and you pay $500,000 of cash. Okay, let's say it goes up to 700,000. Okay, you're gonna have no liabilities, but now your equity, your net worth as the owner, is also going to be 700. 500 of your contributed capital and $200 in earnings, right? We can say. Okay, so now let's do the same movement on your asset, your house going up. And so, okay, so final thing, what is the return on this? Okay, you invested 500, you got $200,000 in kind of earnings. What percentage profit, you can say, have you made? 2/5, 40%, right? This is your return on your investment. Do we agree? Yeah? Okay, so let's do it now with using a mortgage. So you have 500K. Let's say you borrowed 450, okay? And then you put up 50,000 of your own dollars. Okay, so your down payment was 50,000, you borrowed 450. Now it goes up to 700K. You still have 450 in debt plus. Now to make this balance, it's going to be what? 250? 250. It's not entirely right. Okay, so let's do a little bit of extra details here. If you were to sell the property, okay, you're gonna have to pay interest too. Okay, so let's say you had to pay uh, 10% interest. Okay, let's just make it kind of easy math. So you're gonna pay $4,500 in interest. Okay, or 45,000. Sorry, right? 450K times 10%, 45,000. So you're going to receive 700,000. So it's going to be on this side in cash, 700K minus 45K in interest. And let's say you're going to pay off your debt, minus 450K. Okay, so what is the math here? How much cash are you going to have at the end of this? Someone want to help me? 450, 250, 205, right? 205. So you're going to have $205,000 in cash, no debt, and 205K in equity. Okay. So you actually have like less equity value, right? In this case, you had 700,000 in equity value. But let's calculate our return on our investment. Okay. So of this 205K, remember, we only put up 50K. How much is profit? 155K. we've tripled our money. Okay? So this is like whatever, over 300% return. So greater than 300%. So your return on your equity dollars when you use leverage is far higher if things work out. This is why businesses will try to borrow, because the owners of the company want a higher return. Yeah? So yes, you're paying interest, but you're getting a ton of leverage, okay? You're using someone else's money to control a $500,000 asset. And if that asset goes up, then your equity returns are going to be much larger, okay? So this is the basic fundamental benefit of borrowing. Of course, if things go badly, your equity dollars can get wiped out much more easily too. Okay, because if it had gone from 500 to 450, okay, in the first case you're okay. You're only losing $50,000 of your $500,000 investment. If it goes down to 450K, you're going to lose all of your money. Okay, so um, your 50K here will be wiped out because the bank still wants their 450 back. Okay, so leverage cuts both ways. That's why people will lend, because if things go badly, they want to have their dollars out first, right? That's why some people choose, if you have $100, you'll lend it to someone rather than invest it as equity. Because when you invest it as equity, you're taking more risk. Okay. Okay. So we have a way of measuring this this ratio between our finance side of the accounting equation. Okay, we call this the debt ratio. Okay, you can see here, it's a ratio between, again, you have assets equals liabilities plus equity. This debt ratio is showing what percent of your assets are financed with debt. Okay, so if you had $100 of assets and you finance $60 with liabilities and 40 with equity, you would get a debt ratio of 60 over 100, which equals 60%. Okay, so this debt ratio is just showing what percentage of your assets are financed with debt. Okay, so what's your intuition? Is it riskier or less risky to have a high debt ratio? What do you think? Is your business taking more or less risk as you have a higher debt ratio? If your debt ratio is 90%, so you see here 90%, that's highly levered, meaning if you have $100 of assets, you finance that with $90 of borrowing. Now, is that risky? It is, okay? So the higher the debt ratio, the more leverage there is on your balance sheet, meaning that if things go well, you're going to have a very high return. But if things go badly, you're going to get wiped out real quick. This is why we always have bank failures. Banks are on this category of highly leveraged. Okay, so if their loans or whatever assets they have, they even go down 10% in value, the bank is bankrupt. Okay, so uh, you know, lower leverage companies, they're gonna, unless they're a really great business that has high returns, like software or like a service business, um, you know, those companies can get away with having low leverage because they earn so much just from whatever services they provide, and they don't need many assets, right? Like if you're an accountant, all you need is like your house. You can even work from your home. You don't need any assets, so you don't need to borrow anything, right? You're earning a lot with very few assets. But some companies, uh, they need to borrow a lot to make it work, to make the returns high enough to kind of make it worth their while.